Welcome back to the channel. My name is Brad. Don't know, I've been retired for over a year, and I'm going to give a big shout out to my new friends from Texas and South Carolina that I played cornhole with last night, and they became a subscriber to the channel. And it was a good time last night. But today we're going to talk about sequence of return risk, what it means in retirement, how you can actually possibly eliminate that. And I'm going to just go ahead and go through some of the NEOS calls and just a bunch of other information on this wonderful Sunday morning. So hopefully you have joined me to follow along with what I am doing and what's going on. But let's go ahead and bring this up onto the stage. And one other thing, nothing's financial advice or any other advice, but let's go ahead and look at this in sequence of return risk and what I'm talking about. So if you go ahead and look at the chart, you can see the performance of the S&P 500 since 1980. Last week, I kind of talked about this. 1981, 401k officially became the thing because of the IRS rule clarification. So 92 and on, life was good because we got 401k and people were just pumping the market. And we can see how that has worked. But at the same time, if we move to another chart and we show the drawdowns, the inner year decline, and that's where we get into, oh, I'm just going to sell some SPY shares. Well, okay, are you going to sell it at a 49% loss? Now, that doesn't make sense. That's why we income invest, so we can not have to sell during the drawdowns. You can see that every single year there was a drawdown. There you have it. Somebody else's chart, by the way. So easy for me to point out that every year we have a inner year drawdown. So how can we avoid that? And this is twofold. One, can you totally avoid it? Probably not. Can you hedge against it? You probably can. And that's where we get into how does this actually work. So one thing I've done, and this is me, and this is more recent, because the last time we had a big dip, I sold my growth and waited for it. But I've read these two books, two great books. The links in the description down below. The Q and TQQQ, he talks about his indicators and how he was able to beat the market by buying and selling and holding just treasuries. And I'm like, okay, that's great. That's one way you can do it. And then Buy and Hedge, Jay's book, is like, talks about, and on page 32, I remember the page exactly. He talks about we could hedge to avoid the downturns. And I'm sitting there going, interesting. But one thing, and this is why I read the books. One thing in the QQQ and TQQQ Profit Machine book, he mentions on a couple different pages about a service that's able to actually been very consistent for 30 years of calling not exactly the top, but tells you that, hey, something might be coming. How far it drops, they don't tell you. I can't tell you how far it drops, but it may drop. And we're just going to go ahead and move to that one. So VictorVest, I don't, put it like this. VictorVest, I tried it out. I looked at it. I looked at their calls and said, that's interesting. They were able to dodge all the downturns, and they did it for 30 years. So when somebody says, well, I've never met, all I got to do is point you right there. They have done it. And I'm sitting there going, that's interesting. $69. And I'm sitting there going, that's a little pricey for Brad to sit there just in case the market goes down. So I looked at their calls, and I can tell you they're not using moving averages. They're not using RSI. They're not using MACD. They're not using any of the indicators that was in the QQQ and TQQQ book. And I'm sitting there going, that's interesting. But then I saw one distinct mark, and I said, I know what that is. So I went out and I said, I could build one myself. And lo and behold, I can tell us when to hedge and when to get back into the market. Now, this is really from a video. Somebody literally asked me, what did you do during the April downturn? Or for April. Well, guess what? We got out in February. Why are you waiting for April? I just want to point that out. The indicator got us out in February. So we didn't have to ride it down to the 200-day moving average. And that's the actual red line on the chart there, by the way, going across. So we were able to get out. Now, the problem you have is this is end of day signal. So it shows you the end of the day. When you get out the next day, that's all up to you. Or put your hedge on or do whatever you want to do. And you can do a lot of different things. And everybody's going, oh, I don't want to buy a put. You don't have to buy a put. Maybe you put 10% of your profits and just hold on to them to buy the dip. That's a hedge. Maybe you put it in the inverse. That's a hedge. Maybe you buy a put. That's a hedge. There's so many ways that you can do this. It's just available. You don't have to be afraid of the big bad downturns anymore, because we can figure out when you can hedge, and you can do all kinds of things. And I already told all the members of the Circle community that, hey, this is what I'm going to do. And no, I'm not going to a Delta Zero hedge. And my whole plan is I want to generate a little bit of downturn money. So I want to profit during the downturn with my hedges, and then just take that money and reinvest at the bottom. Or not exactly at the bottom. It tells you when the bottom is, but you don't get the bottom until the next day, and it could be covered. So it's not an exact science, but it gets us in around when we should be getting into the market and when it's risk on. And that's interesting. And I share this every day on Circle. And if I go out to a larger screen and I can see the April downturns, I can also see the Japan carry trade. I mean, it just pops out at me. Hey, there is times that we can actually be hedging, making a little bit of money, locking in profits. That's another one. You can literally lock in profits. Just a way of doing it. I mean, there you have it. There's so many ways that you can actually create that little bit of hedge, 10%, sell it, put it in, right? Here's one real good one. I was thinking of a 10% hedge in my portfolio, including SGov, YQQQ. Now, I love YQQQ. I do. I actually think that is a huge one that we can actually say that is so interesting. I just wish it was a weekly payer. If it was a weekly payer, that would be my hedge, because I could literally take 10%, 15% and roll it into YQQQ, and I wouldn't have to buy any puts because it did extremely well. But the problem of it is if you're hedging all the time, you're losing money. That is the problem. You only want to hedge when you need to hedge. And that's really what the red signals are. Those are when you probably should have a little YQQQ. So right now, the chart says no hedge. When it does, I'll hedge. And all the members in Circle will know about it. So I went back and I back tested this. I went back 10 years just to make sure that I wasn't full of it. Because, I hate it when people get on YouTube and say, oh, I did this and I did that. I give you the exact dates of when we got out of the market, the exact dates. Now, I'm going to also point out that there was 2 times that it was a losing trade, that the market actually went up. One time was 1.17 and the other time was 1.71. But what you notice is 18.5, 16.2, 20%, 27%, 8%, 8%. You avoid, or you actually can make a little bit of income or grow your account a little bit by those percentages in a downturn instead of taking all those losses. Then I went back to the great financial crisis. Well, guess what? We were out of the market, into the market, and we actually generated, if you went to a delta 0 or -1 delta, 79%, but the total drop was 56%. And you can literally see the dates that I would have put the hedge on. I would have put the hedge on October 12th, December 11th, May 20th, August 12th, and January 9th. And then you just ride the hedge down, and then when the green says risk on, you go back to risk on. No reason to be hedging when it's risk on. Just my personal opinion. So one of the members in Circle wrote this on a video here recently, and we touch everything. We talk about growth versus growth. We talk about income. We talk about NAV erosion. We talk about the curve funds with the new silver funds. We talk about a lot of different stuff in the Circle community. And by the way, I'm not like VictorVest where they're charging that whole entire $69 a month. You can join the silver program for $8.99 and get pretty much the same. Now, VictorVest does do every single stock. I don't. I just show the indexes, the gold, the silver, what's going to go risk on, what's going to go risk off, Bitcoin, and everything else that's in there in that particular basket that I'm invested in. Because, hey, if silver starts to go negative, maybe I sell my little bit of the silver miners and I hedge against it. Not much, but I can hedge against it and actually generate a little income so I can put that back into my income funds. That's all I'm doing. Nothing special, nothing like crazy weird that we're going to do all kinds of stuff. You just want to be able to protect your little bit of nest egg so it doesn't run out in retirement. Now, I went on to Snowball. So I was tracking everything, and this is just me because I'm just getting lazy. I went out and I was tracking everything in a Google Sheet, and it was just, it's a nightmare, especially if you have a bunch of weekly pairs. Because if you got a bunch of weekly pairs, you don't know when it's coming in and what's going on. I mean, it literally got to be almost a full-time job tracking my distributions so I could do videos about, wait, what did I make 500K? Well, Jesus, baby, you know, I got all these funds and they pay every single week and I got to add them all up and I got, oh. So I went to Snowball. Is it perfect? And full disclosure, is it perfect? I'm going to say, no, it's not perfect. I own TDAC. TDAC has not made a distribution yet. So when I look at it, the projected income, it doesn't include TDAC. Now, there's a link down below if you'd like to join, and you get a 10% discount. It's pretty, I'm using it, but there is those little things like TDAC, the new silver fund from Curve. It's not going to project that income because they have not made a distribution yet. But once they make a distribution, then it will project it out in your monthly income so you can see where it is. So I look at what's coming in next week, and here's a great example. I got all next 2 weeks. This is everything that's paying me. I mean, it's literally sitting back and going, that's a lot to try to keep track of. But you can see what my income approximately is for the week and how it comes in. Now, I only live on 8%. I take a small section out and I reinvest into something, whatever it is. Right now, I've invested in silver. I'm investing in REITs and stuff like that. You know, the NEOS fund, actually the State Street fund. And I'm doing a little bit of energy because energy is getting beaten down right now. And eventually, I'm going to turn to business development companies. If you don't know, I sold some business development companies and now they're getting beat down. And eventually, right around when the rate cuts stop, I'll be piling back into more business development companies. Because that's one thing about business development companies. I take all the distributions. If it's paying me 9%, I just take it all and I reinvest what I want in something else. That's a very interesting one. And right now, my projections on Snowball, it's about 147,000. Right? I'm just going to throw it out what Snowball is telling you. I'm getting about 12,000 a month, but that does not, and I say this again, does not include the new silver fund and TDAC and their projections of what they're going to pay. And TDAC's actually a fairly large holding for me. So this is going to be a little bit higher than what it is, but I just thought I'd throw it out that, hey, about $12,000 a month in income. It's probably going to be closer to that 14,000. But I do not, and I will pound my fist again on the table, I do not take $14,000 out and say, you can live on this. Not how it works. It's closer to that 8%. And this month, just got done talking about the budget with my wife. Doesn't look like I need to take any out. So I'm going to be able to reinvest it all because we're doing very well with our budgeting. And you should have a budget. Now, let's talk about the NEOS funds, because you guys know that I track NEOS and I look at their calls, and this is where they started September. So this was the start of September, and you can see where they wrote it. SPY-I was 1.4, QQQI was 2.1, and you can see where they wrote it, and you can see that BTCI was at 7.8 and 12%. Keep those numbers in your mind, and maybe I'll come back to this. This is where they ended up. They ended up SPY-I in the money on both of their calls. QQQI went through both of their calls. Bitcoin was not in the money. They were both out. The gold went right through the calls, right? Whew. They gained what they could, but it went right through the calls. But let's go ahead and look at what the calls were on October 1st. You can see the SPY-I is very consistent. Last month it was 1.7. I said 1.7 last month. 1.47. This month is 1.52. So you can actually compare where these are. You can see that BTCI is right there at that 7% again and 12%. Very, very consistent on how much out of the money they are on their calls. The gold fund at 2.68 is higher than 1.55, which is a good sign. So it's just about where they are and how much volatility is it, so they can write the calls a little farther out of the money, and they can reduce how much they wrote on the underlying. I didn't do that math yet. Maybe this week I'll do a video about NEOS directly, but I wanted to share what this is at. I go back to that circle thing. All the circle members have already known this. I shared that from day one with the circle members, right? You know, so let's go ahead and walk through this. All right, and it says, careful, Snowball has lots of bugs and incorrect information. The incorrect information, okay, the incorrect information is it pays, the calculation is on last month's or last week's distribution, and if the distribution changes, they won't know it until it occurs, so they can correct it. It's only giving a projection off of last time that it gave a distribution. So people are like, oh, it's got all kinds of bugs, and it does this, and it does that. The market's going to go down. It's going to do this. It's going to do that. Stop. Just stop. It's craziness, the craziness that's out there. Just calm, cool, collective. It gives it close enough so you can know what you got coming in. It tells you when it's coming in, approximately how much is coming in. And if you're trying to do your life budget off of it, you got a serious problem about thinking about how close you are on the edge of living life. Don't sit there and think about how, oh, I need $1.99. I got the limit orders and market orders. And somebody's like, I only use limit orders. Well, the spread is 1 penny and you're using a limit order. Yeah, now the spread was 10 cents or 15 cents. I can understand that. But when the spreads are 1 penny and you're sitting there with limit orders, okay, don't waste everybody's time. You can do good stuff, but everybody's different and everybody can use limit orders. I always, especially if a fund is not very liquid. And then another one is when it's pre-market and the volume's low already and you complain about the spreads, I almost want to call you an amateur investor, because you should know it's pre-market and you should know that the spreads are going to be big. I don't get it. I don't. Literally, I've seen that comment every single month. Oh, the spreads are big on this. It's 7 o'clock in the morning, Eastern Standard Time. How many people are trading it? Oh, well, maybe that does have something to do with it. Well, why don't you trade during trading hours? That's another good one. You should probably never trade during trading hours until after 10 o'clock. But that's just a little tidbit that I've learned over the years, is use limit orders on very illiquid stuff and go ahead and go with stuff. We're just going to go through the comments and say what we got. Champs, good morning. Good morning, Jess. Good morning. John held off doing the car suspension. If you don't know, John is a member of the Circle Group and watch before the car work. Yeah, and John is going to hit the road, and he's going to be out on the road enjoying life in retirement. All right, thanks for the total performance charts, Brad. Which ETF would you replace API with? Well, I replaced it with GPTY. Clearly, GPTY has done better on the charts. Right? What if you buy SPY for 10 years and after that start selling options against it? Yeah, well, sure. Why not? Okay. And when you get it called away, then what are you going to do? Start throwing it out, or are you going to roll it? What's your plan? Are you going to roll it? Are you going to get called away? What's your plan? Can't answer it because I don't have all your information. You can do this. And why are you buying shares? Why didn't you buy poor man cover call and buy it out 2 years in advance and just sell against that? I mean, I don't know. There are so many ways that you can do it. I'm not here to tell you what you do or not do. I'm just sitting there going, you can figure it out yourself. You don't need to ask me, should I sell options if I bought it 10 years ago? Does it matter that you bought it 10 years ago? No, it doesn't matter if you bought it yesterday. And then it really goes into, hey, if you have a brokerage account, why do you even own the shares? You can sell it naked and do it that way. So I don't get the comments. So we'll just go and say, hey, do what you want to do, but have a plan. That's the bigger portion. If you got a plan, no problem. Hey, Jeff, how we doing? Right. Still, this is the one goes back to TQQQ. I'm telling you, I really, really, really like that fund. It does really, really good performance in a downturn. My problem with it is they don't pay weeklies. And maybe that is going to change. And if it does, that will be my perfect hedge fund to hedge the downturns, because it really does exactly what I want it to do. Now, again, you can do what you want to do. Some people like buy puts. I don't know. They actually, one comment was made, and it's a really good comment. And I'm going to kudos to the person in the circle that made the comment to me. And when it goes risk on, can't we just buy a call? Smart, very smart, because you could buy a call and the market goes up and that call becomes worth more money and you control 100 shares at a lower price. So yes, you could buy a call, but then again, it's all about your risk management, not my risk management. I tempted to do it, but that's the maverick in me. But you could, right? Hello from Japan. So good morning, good evening. I don't know, it's probably one of those two. It's probably evening time, his time. Is your indicator 20-day? Nope, not moving averages. And everybody, even in my circle group, oh, how are you doing it? Give us the indicator. I had the exact same message on my last one. And no, it's not. And matter of fact, if I bring back up the charts, right, and I go back up at the top, that's the 20. The other one's the 50. You notice that we got out way before the 20 and the 50 crossed. Way before. That's the difference. So no, it's not the 20 and 50 crossing. That's what I thought when I first looked at it and said, what are they doing different? And I was able to identify what they're doing. And everybody's like, well, just tell us, let us do it ourselves. And I just go, it's a lot more nuisance. There's a lot more going on than just, oh, it's going to do this and it's going to do that. It's telling you there's a lot more to it than just that. But people will just continue to make the comments, oh, it's just this. No, it's not. It's just crossing the 200. No, it's not. And you got to think about what it's doing. And I spent 2 weeks looking at what they were doing and comparing it and saying, that's what they're doing. Is there ways that you can go out and find indicators that are close? Yes, but what the problem is, it gives you a lot of noise. You have to fine tune it per the index, per Bitcoin, per the stock. There's a lot to it than just it's this. No. And everybody just wants that secret sauce of how you can quickly get in. And the answer is no. There's actually market makers give you the signal. And there you have it. The market makers, the people making the market actually tell you that the reversal is happening, and it's happening way before the 20 and 50. It's happening way before it's getting to the 200. You just have to know where to look to get the information and then weed out the bad information or other crossovers, or make sure that you get a confirmation of the RSI and the MACD. So no, it's not the 20 and 50. Good guess though. What about Salty as a hedge? You guys are funny. Hey Jeff, that's funny. That's a good one. I mean, sometimes the ticker indicators and not the actual indicators. Yeah, there is times that it gets cleaned up and it's getting better all the time. All right. When will the boosted funds from NEOs come out? Wow, there you go. If you were a member of the Circle community, I've already given the dates. I'm just not going to go look on my computer to find out the dates for you, but I've given you the dates. You can go out to the SEC, just like I can go out to the SEC. You can look at when they filed, and then you can add 75 days to it so you can figure out when the closest date is for them to release. All right, and there's several serious issues with it. technical support severely lacking. I didn't know what you're talking about. Don't know what you're talking about because they get back to me every single day. Can't remember they're in France, right? So I don't know what you're talking about. They've gotten back to me every single day within 24 hours, right? Probably because you're just writing questions and they're like, what the hell is this guy talking about, right? There is a money to be made. Take advantage of naive people doing off-hours trading. Scary. Yes, off-hours trading is scary. It is. I've looked at that. I've looked at going, could I take advantage of you? Because I saw somebody paying almost a 2% premium for TDAC. I said, man, so much shares. Just buy the next day because it did not go up 2%. Why are you paying a 2% premium? If you want to pay 2%, I'll take it. Right? Would you consider a fun weekly Maverick pick video? Maybe for the circle group. Maybe I would. Right? I saw your video with Howard and the new K Silver. In your opinion, what do you think the yield would be? 18 to 20%. Tell you that one. That one I know off the top of my head. Somewhere between 18 and 20%. Are you looking at I don't know. Am I looking at this one? Am I looking at that one? Am I looking at this one? I don't know. Like I know every single letter is under the sun. There is a couple new Roundhill weekly payers coming out. Maybe I'm looking at those. Do you know about those? Do you know about those GEWY? I don't know. Right? Don't know. Are you looking at the GEX part of no? Oh, GEX? No. Again, no. That's not how it works. Sorry. Keep on guessing. You'll never, ever, ever figure it out. That's what you're thinking. Not even close. Not even close. Apologize for not knowing what's your favorite RealMax funds. Would you buy any right now? So I believe in sectors. I believe in AI. I believe in semiconductors. You look at GPTY, Chippy, Soxy, and I have been saying this for months, not just this week, last week, 2 weeks ago. GPTY, Chippy, Soxy, doing well. Just thought I'd throw it out. 3 funds that I don't mind from YieldMax. Right. Now that I said them, they're in my portfolio. How about that? Salty. Okay, we'll just leave off about Salty. We'll just leave off about Salty altogether. That's just terrible. Salty's just salty. If you want to go ahead and play with those funds, feel free. Feel free. No, it's because they don't know what I am talking about. Yeah, probably not. Sometimes I don't know what you're talking about, and I have to sit back and think about it. All right, there are serious issues. Okay, whatever. Yeah, whatever. I mean, come on. I get it. You don't like it, you don't have to do anything about it. Serious issues. Oh, so it's pandering that you're the same guy that said the market was dropping last week, week before. I got to put a hedge on week before, and the market's been straight up. Might want to think about where you are. You know, there's nothing awful bad about it. Is there issues? Yes. If you're just going to be nay, I'm just not going to put any more of your comments up because I can't handle the nay-ness. Because that's, go watch somebody else. Really, seriously. Next guess. Liquidity measures, widen bid-ask spreads, high volume. Yeah, okay. Yeah, there's all kinds of stuff out there, right? All kinds of stuff out there. Oh, thank you. Quantum. Yes. So we have a conversation about quantum. we do. There's a conversation about quantum in the circle group. And there's also nuke and uranium and other conversations about other places that you might want to be looking, especially for growth. Not so much for income, but for the growth sector, we have those conversations, and QTUM has been part of those conversations. Yeah, T-SPY consistently appreciation every month while offering a high distribution. My thoughts. If you haven't been watching, Psy is on the channel regularly, and I will be with Psy in 2 weeks, ringing the bell in Chicago. If I wasn't a big fan, I would probably not be going to Chicago. So yes, they do extremely well. And remember, there's the fishing rods. I like 0DTE, which is T-SPY. I like longer dated calls, which is SPY-I. I like at the money calls on a very small percentage of my portfolio, and that's GPIQ. I got rid of GPIX and went more towards the Qs. And I have all three funds, because which fund does the best on tomorrow? Not going to guess. Just not. It's not worth it. Right? More money is lost predicting a downturn than getting out of the market. Obviously, he hasn't looked at the charts. Obviously, everybody has their own opinion, right? Everybody has their own opinion. Obviously, I've gone back, show you the data. You can do what you want to do. That is totally fine. And I've had market experts say, you can't predict it. Well, somehow they've been able to predict it for 30 years. So get over yourself thinking that you know everything about the market. And maybe you should be reading the QQQ and the TQQQ book to see what they say how you can beat the market. Just pointing out that it's literally from somebody from JP Morgan sat there and wrote the book, and then he put 2 and 2 together and said, wait a second. And he talks about VictorVest. He literally points you to who has been doing this for 3 decades. So there you have it. Hedging is not necessarily getting out, it's hedging. And that's exactly right. Exactly right. How you play it is totally up to you. Maybe you just buy some puts. Maybe you change it to the inverse. Maybe you just go to cash. Maybe you do something else. That is totally up to you. And that's why I keep on screaming at everybody. I'm not going to sit here and tell you need to buy puts. You need to do this. You need to do that. You need to move here. You need to move there. I mean, I got guys going like this all day long. And it's just like, no, slow down. Figure out what you want to have done. Create a plan. Have a perfectly written plan, exactly step by. And there's certain things in my account that I have to do. This step first before I do this step. If I skip a step, doesn't work because I skipped a step in the mechanics of how my, and your accounts might be different, how my accounts work. So I have to go step by step or I can't do it correctly. And you should know that before you want to put the hedge on. That is the most important part. I'm actually listening to you. You provide great analysis, but yeah, it's enormous benefit. Yeah, I know. And I always listen to you too, because there is stuff that you say that makes me think. And I really, really appreciate that because he does. He's in the group, in my circle community, and he really makes me think some days. It really makes me go beyond just the regular boundaries. And that's what I think I pointed this out last week. There's boundaries that I used to dial up on old dial phone, right? And then somebody's like, well, you know, you should just ride it down and ride it back up. Well, that's always you got to be thinking about what's coming and what's changing. Things are changing. The opportunities are changing. You need to take advantage of the opportunities and not get sit back and complacent on what you're doing in your accounts, because complacency is probably a wealth killer. Being proactive, thinking about it, creating a plan, figuring out step by step, figuring out I have to buy the put before I do anything else in my account. Because if I do anything else in my account, I can't buy the put until the next day. And it has to do with the T+1 rules. Nothing else. Nothing else. So knowing step by step exactly what I'm going to do in order gets me to where I want to be quickly and not in a rush, not in a panic, not wondering what I'm going to do. Step by step planning. And I got into, we're just going to throw this out and we're going to close on this. I created a step by step of everything that you need in your retirement plan from the David Nicholas about the financial advisor. He gave a lot of nuggets, and people were like, well, why do you use a financial advisor? Blah, 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 blah. Well, he gave a lot of nuggets. Do you have power of attorney? Do you have benefits on everything? We created a complete checklist, and there was things that I left off that in the circle group, and they added, and now we have a complete checklist. If you're going to do it yourself, with or without a financial advisor, doesn't matter. You need every single one of those components, or at least a variation of them. And you can do it yourself. You can hire a professional to help you do it with you. Either way, it doesn't matter. But there was a bunch of steps in there that people weren't listening, and they were just thinking, oh, I don't want to use a financial advisor. Well, gave a lot of good information in there that you should have probably be catching. And that's the problem. You should have caught that. A couple more, and then I'm going to call it the morning. And it is, I have been buying T-SPY and TDAC. Two great funds. I hold them, right? They're above my cost basis now, so I don't need to. I put in my percentage that I wanted in them. They're going up. And there you have it. My indicator says hedge. I'll take a little bit off. Collecting profits, right? Capturing those profits, because once I sell, I'm capturing the profits. And that's one of the benefits when you buy an ETF that's appreciating in its net asset value and depreciating the asset value, that you can take profits at the right time. And then I can reinvest those profits back into the fund when the fund's a little bit cheaper. Just another way of doing it with tools that are available today. In your opinion, what percentage of your portfolio should be in gold and how much in Bitcoin? So I don't have an opinion. I do not have. I'm going to tell you what I have. I have a basket at Fidelity, because they have baskets. 15% of my income portfolio is split between Bitcoin, gold, and silver. That is how my basket is set up. Not financial advice or any other advice, but I think what they're saying in the market, you should have at least 5% in Bitcoin. How much you have in gold? It's totally up to you. I just know that I have 15% of my total portfolio invested in gold, Bitcoin, and silver. Totally up to you on your percentages. That does also give me a slight hedge, but that's not really hedging in the term of buying a put against the actual equities. But it keeps my portfolio going up because there's been days this week or the last 2 weeks that the market was down and gold was up. So I was sitting there going, my account didn't go down as bad as others because gold has been on a tear. And you can do the gold funds, you can do the curve, you can do any of the other ones. It doesn't matter. I just like the ETFs that I can actually see what they're doing. That's my thoughts. If it's an ETN, I can't see what they're doing. Your thoughts on YPTC? YBTC has not done as good as BIDI and BTCI. At least that's what I have seen. I think it's changed a little bit. I'm not a fan. Just sorry. BIDI and BTCI. Now there's also that BCC, I do believe. It's a weekly pair, but I just don't get into all the hype about that. Now, Rex Shares is going to come out with their double I on IBIT. So they're going to create the synthetics and they're going to pay weekly and they're going to do leveraged and they're going to write only 50% of the portfolio is 62.5 and then 62.5% of the portfolio is uncapped. So, and they're going to write at 2% out of the money. So you get upside. That might be interesting. And those, if I'm not mistaken, if I look at when they registered with the SEC, those should be thereabouts next week or the following week. They should be cleared to be able to launch those funds. But I do not work for the fund manager. And just because they're cleared to do it doesn't mean that they have to do it. Just that they're cleared to do it. But we'll see when those funds actually come out. Have you ever heard of? Okay. Well, whatever. It's really interesting to hedge my portfolio without buying and holding inverse. I appreciate the thought. No. Let's say here we go. It's impossible for me to know all 4,275 ETFs with 15 more coming out every single day. It's impossible for me to know. And I don't have 100 people sitting in the back, but I'll look that one up. I'm going to look that one up now. See that on a chart real quick because it's interesting. That way I can make sure that I actually no. No. The answer is no. I just real quick looked at a chart and the answer is 100%. 100% no. Just so I thought out. Yeah, SQQ actually is paying a nice distribution. Yeah, exactly. Right, but BTAL, you're doing the same thing. I mean, it's nothing. Let's go like this. Let's go SQQQ. Yeah, it's done really it's a little smoother, but not much. Are you investing in commodities and projection commodities super cycle? Just so I talked to a commodities manager last week. Interview coming up this week that I'll actually post it live, and you might be surprised at what his comments, and he's been doing it for 30 years about commodities. Don't believe all the hype, right? Certain commodities. YQQ is also paying monthly, not weekly, which if it was a weekly, I'd be more into it. I'm hedging and collecting my Alti. Jeez. So a smart person would have bought the put on Alti 6 months out in advance because Alti is just great in an up market, but a down market, they just get hurt. And that's, yeah, don't believe the hype. All right. So anyway, until next time, God bless.